Everything you heard about banking was a lie. You have been taught your entire life that a bank is just a safe, neutral vault where you keep your hard-earned money. You put your paycheck in, you take your cash out, and maybe, if you're lucky, they give you a tiny fraction of a percent in interest. But pause for a second. What if I told you that behind the polished marble floors, the smiling tellers, and the slick mobile apps, there is a hidden, cold, and highly engineered algorithmic architecture? An architecture designed to do one specific thing: categorize you. The thing nobody in the financial world wants you to know about is that the banking system is not a ladder you climb. It is a caste system, a series of locked rooms. There are three distinct tiers of banking in the modern world. Tier 1 is the penalty of poverty. Tier 2 is the illusion of the middle class. And Tier 3 is an ultra-high net worth parallel universe, a reality where taxes become entirely optional and the fundamental laws of mathematics are rewritten in your favor. I wish I knew this earlier, because understanding this system is the only way to beat it. Today, we aren't talking about generic advice. We aren't talking about how rich people get better interest rates. We are digging into the actual plumbing, the hidden legislation, and the shadow algorithms of the global banking system. Here's the real truth. By the end of this video, you will look at your bank account completely differently.
We begin at the absolute bottom, Tier 1, the mechanics of being broke. This tier represents anyone with a bank balance hovering between $0 and $1,000. If you are in this tier, the bank does not view you as a valued customer. They view you as a harvestable asset, and they use highly engineered algorithms to extract whatever pennies are left in your account. Let me introduce you to a piece of financial engineering known as the high-to-low reordering algorithm. For decades, you probably thought overdraft fees were just a natural consequence of spending more than you had. You're doing this wrong. Banks didn't just passively charge overdraft fees. They intentionally manufactured them. In the 1990s and 2000s, major banking mainframes were specifically programmed to process your daily transactions from the highest dollar amount to the lowest, rather than the chronological order in which you actually bought things. Imagine this exact scenario. You have exactly $100 in your checking account. It's Monday morning. Over the course of the day, you buy 4 small coffees, each costing $5. That's $20 spent. Later that evening, you do a $90 grocery run. If the bank processed your spending chronologically, the way time actually works, you would have $80 left after the coffees. Then your $90 grocery bill would bounce. Your card would decline, or you would trigger one single $35 overdraft fee.
But that's not what they did. The bank's algorithm pulled the $90 grocery bill to the very front of the line and processed it first. Instantly, your $100 balance dropped to $10. Now, 3 out of your 4 small $5 coffees bounced. By simply reordering the math, the system triggered 3 separate $35 fees instead of just one. They manufactured over $100 in penalties out of thin air. This wasn't a glitch. It was a multi-billion-dollar business model that led to massive crackdowns by the Consumer Financial Protection Bureau, forcing Wells Fargo to settle for $203 million in 2010. But what happens if you can't pay those artificially inflated fees? You don't just get a penalty, you get exiled. Nobody mentions this, but banks operate a shadow credit bureau called check systems. If you leave an account with a negative balance, you are blacklisted. You are banned from opening an account at almost any other traditional bank in the country. And the most sickening part, consumer advocacy groups have historically found that a massive percentage of these financial exiles are handed out for unresolved balances of less than $100. For the price of a nice dinner, you are excommunicated from the modern economy. This exile created a desperate, unbanked population, and where there is desperation, there is profit. Enter the no-fee fintech apps, companies like Chime and Cash App. Everyone in the low-income bracket is using these apps. That's exactly why they're stuck. Mainstream finance influencers ignore exactly how these free apps make billions off Tier 1 customers. It all comes down to a government loophole from 2010 called the Durbin Amendment.
Part of the Dodd-Frank Act, this amendment capped how much megabanks could charge merchants for debit card swipe fees. But they left a back door open. The cap exempted banks with under $10 billion in assets. Fintechs brilliantly partner with these small shadow banks. Because they are technically under the $10 billion threshold, they are allowed to extract massive, hidden, uncapped swipe fees from merchants every single time a poor person buys basic necessities. This regulatory loophole is exactly how they fund their free banking. You aren't their customer. Your transactions are their product.
Ironically, normal checking accounts used to be completely free for everyone. Prior to 1980, checking was free, but banks were legally barred from paying you interest on your deposits. Then came the Depository Institutions Deregulation and Monetary Control Act, or DIDMCA, of 1980. This allowed banks to offer interest-bearing checking accounts, but to offset the massive cost of paying out that interest, banks simply invented the minimum balance requirement and the modern monthly maintenance fee. They created a system perfectly designed to squeeze poorer accounts to fund the interest paid to the middle class. And the ultimate insult? The internal terminology used by the banks themselves. If you are a highly responsible person who pays your premium credit card balance in full every single month, the credit card industry historically refers to you as a deadbeat or a transactor. Why? Because they lose money funding your luxury travel rewards. But if you are a low to middle income person struggling to get by, carrying a massive balance at 24% interest, you are called a revolver, and you are their favorite, most profitable demographic on earth. Which brings us to Tier 2, the middle class squeeze. This represents balances roughly between $10,000 and $250,000. In this tier, you aren't paying overdraft fees anymore. You have a decent credit score. You have a savings account. You feel like you're winning the game. But the hard truth is that common belief is holding you back, and you don't even realize it. You are locked in an invisible, algorithmic cage. You might assume that the elite megabanks could easily dominate this middle tier. But when a true, ultra-wealthy bank tries to serve regular people, it fails spectacularly. In 2016, Goldman Sachs, a bank historically built exclusively for billionaires and corporations, launched a project called Marcus. The goal was to capture everyday retail consumers, to bank the middle class. It was a disaster. By 2023, Goldman had lost an estimated $3 billion on the project and began desperately shutting down their consumer lending arm. It proved a fascinating reality. A bank built for the ultra-rich literally lacked the internal DNA, the software, and the gritty debt collection logistics required to deal with the messy, unpredictable reality of middle-class lending. While lower-tier customers are blocked from wealth by bad credit, affluent Tier 2 customers are algorithmically blocked for being too smart with their money. If an affluent person tries to game the system, opening too many premium credit cards just to harvest the massive sign-up bonuses, the banks deploy automated shadow blacklists. Chase uses the infamous 524 rule. If their algorithm sees you have opened 5 credit cards across any bank in the last 24 months, you are handed an automatic, undeniable rejection. American Express takes it a step further. They use a literal pop-up jail algorithm. As you are typing in your application, a pop-up intercepts your screen, warning you that you are permanently blocked from earning bonuses. But the real barrier keeping Tier 2 customers trapped isn't credit card points, it's government legislation. It is technically legally illegal for a bank to offer its best investment deals to middle-class customers. Under SEC Rule 501 of Regulation D, you are barred from the greatest wealth-building vehicles until you hit exactly $1 million in net worth, excluding your primary residence, or $200,000 in annual income. Once you cross that exact mathematical line, a switch flips. You become an accredited investor. Only then can banks legally pitch you high-yield private equity, exclusive venture capital, and lucrative pre-IPO placements. The bank isn't withholding these products to be mean. They are legally bound by the government to keep you out of the VIP room. Stop scrolling for a second. Forget everything you know about money. We are now entering Tier 3, ultra high net worth. $5 million to $50 million and beyond. In this tier, you don't use the bank. The bank works for you.
The rules of risk, taxation, and mathematics completely change. VIP banking tiers are notoriously secretive, but one was violently exposed to the public. Between 1996 and 2008, Countrywide Financial ran a phantom branch, completely hidden from the public eye. It was called Branch 850. Operated directly by CEO Angelo Mazzillo, this was the Friends of Angelo VIP program. They bypassed standard underwriting entirely. They handed out heavily discounted, zero-fee mortgages to powerful politicians, government officials, and Fannie Mae executives in exchange for political influence. This is the reality of Tier 3. If you have enough leverage, the rules are strictly negotiable. But how do the ultra-rich actually protect their cash? You know that the FDIC only insures bank deposits up to $250,000. So what happens when a billionaire wants to deposit $10 million in cash? They don't just risk it. In 2002, Eugene Ludwig, a former U.S. comptroller of the currency, created a financial masterstroke, now known as IntraFi. Using their insured cash sweep system, a single bank can take a rich person's $10 million and quietly, algorithmically chop it into tiny $249,000 chunks. Overnight, those chunks are swept into a massive network of thousands of other partner banks. When the client wakes up the next morning, they look at one single statement. They see their entire $10 million sitting right there. But behind the scenes, it is fully 100% FDIC insured across 40 different institutions.
But Tier 3 is ruthless. Private banks don't just politely invite you in. They aggressively kick you out if you slip below their tier. In July 2023, the elite UK private bank Coutts closed the account of prominent politician Nigel Farage. While political views dominated the media headlines, the bank's internal, leaked justification revealed the cold, mathematical truth of Tier 3. His mortgage had expired, causing his total funds to drop below their strict £1 million commercial threshold requirement. He was no longer rich enough to exist in their ecosystem. The ensuing debanking scandal was so massive, it caused the NatWest CEO, Dame Alison Rose, to resign. If you do manage to stay in, the service you receive is completely alien to the middle class. The service disparity isn't just about politeness, it's a strict mathematical capacity constraint. A standard retail customer service call center rep handles accounts for thousands of people every single day. In true private banking, the strict industry standard is a 30-to-1 ratio. A single private banker handles roughly 20 to 50 families, total. You aren't getting better service because they like you. You are getting it because you have mathematically purchased a massive fraction of a human being's total professional bandwidth. And this brings us to taxes. I wish I knew this sooner. The ultra-wealthy don't use standard consumer loans. If they want to buy a yacht, a mansion, or fund a luxury lifestyle, they do not sell their stocks. Selling stocks triggers a massive capital gains tax. Instead, they use securities-backed lines of credit, sometimes called Lombard loans. Here is the exact mechanic. They pledge their massive stock portfolios to the bank as collateral. The bank then allows them to borrow millions of dollars in cash at rock-bottom interest rates, often just SOFR plus 1%. Because a loan is legally not classified as income, they pay absolutely $0 in income tax. Meanwhile, their underlying stock portfolio continues to grow and compound, often outpacing the tiny interest rate of the loan. USC law professor Ed McCaffrey famously coined this the buy, borrow, die strategy. It is the ultimate financial hack.
But hoarding ultra-wealthy clients has a terrifying dark side for the banks themselves. Regulators are actually terrified of banks having too many VIPs. When Silicon Valley Bank collapsed in 2023, it wasn't a standard retail bank run. It was a Tier 3 bank run. Tech billionaires and venture capitalists suddenly realized their massive, concentrated balances were uninsured. Unlike regular retail deposits, which are sticky, slow to move, and spread across millions of people, ultra-wealthy deposits are highly concentrated. Often classified as brokered deposits, they are massive, unstable institutional liabilities. SVB had an uninsured deposit ratio of over 90%. When panic struck, billions of dollars were wired out instantly via simple WhatsApp text messages between billionaires.
A bank with over $200 billion in assets was mathematically vaporized in a matter of hours. And at the absolute apex of this system, for those with $50 million and above, the ultra-wealthy stopped paying standard wealth management fees entirely. Lower-tier millionaires pay hedge funds the standard 2 and 20, a 2% management fee and 20% of their profits. But at the top, elite families establish single-family offices. Through a hidden mechanic called co-investment rights, major banks will allow these top-tier family offices to invest capital directly alongside the bank's own proprietary trading desk in massive private equity deals. The client gets institutional-level returns while completely 100% bypassing the standard fees that everyone else has to pay. The banking system is not designed to help you build wealth. It is designed to manage you based on the tier you currently occupy. In Tier 1, they extract your capital through engineered algorithms and manufactured fees. In Tier 2, they lock you out of true wealth-building vehicles through government legislation and shadow compliance. And in Tier 3, they rewrite the rules of taxation, risk, and insurance entirely. This changed everything for me, because once you understand the architecture of the system, you stop playing a game where the rules are hidden. Do this instead. Stop treating your bank like a friendly neighborhood vault. Treat it like a chessboard. Understand the algorithms, avoid the shadow blacklists, and start leveraging the exact same mechanics the ultra-wealthy use to preserve their capital.
If you want to survive, you need to understand the plumbing, because the fastest way to true wealth is the opposite of what you've been told. If this video opened your eyes, hit the like button. Subscribe for more deep dives into the hidden mechanics of money, and I will see you in the next one.